Today we're going to be focused on pensions, and if there's ever an issue that's cried out for a marriage between fact-based economic research and public policy, it's, as we know, it's pensions. Pension liabilities are as big as the debt liability for most governments. They've been crowding out the ability of government to provide basic services, and they've also been the cause of some governments going into Chapter 9. And so today we're going to hear about what sort of impact pension liabilities have on borrowing costs, also how they interact with finances, and then we're going to also hear about what happens in the worst case when you have no flexibility to adjust your pension liabilities. So we're going to, again, the format is 15 minutes of presentation, 10 minutes of the discussants, and then 15 minutes for questions and answers, and we'll try to, facilitate as many questions as we can. We're going to start out with Chuck Boyer from excellent school, University of Chicago, and he is going to talk to us about the impact of public pensions on borrowing costs. So, Chuck.
All right, everyone can hear me in the back? Mic's working? Okay, great. So thank you all so much for coming. So my name is Chuck Boyer. I'm a PhD candidate in financial economics at the University of Chicago. I want to thank the conference for having me. I'm really excited to be here to talk a little bit about my research, and even more than that, to kind of get some feedback to see if what I'm doing is useful, interesting. So I look forward to comments. So just a little motivation for what I'm doing. This kind of is a lot of stuff, honestly, that's pretty obvious to people already in this room. As Mike was just alluding to, a lot of attention that has been paid, and particularly in the academic community, to municipal finance in the last few years has focused a lot on the fact that local governments and states have large underfunded pension liabilities. And it's something that has kind of been swept under the rug for a long time, and it's about time we kind of bring it to the forefront. And kind of two things I want to highlight that kind of motivate my research is, one, a recent paper by Michael Schwert, who's now at Ohio State, kind of looked at where cross-sectional differences in bond yields were, whether they're really being driven by default risk or liquidity risk. And some of his findings suggest that kind of a lot of what's going on in muni bonds is in fact default risk and not liquidity risk. And what this kind of does is sets up sort of a challenge for us academics to better understand, okay, what is it though that's driving these kind of cross-sectional differences in default risk? And sort of an obvious candidate to look at, and something people in this room are familiar with, is underfunded pension liabilities. To the extent, particularly, that underfunded pension liabilities are sort of crowding out other bonded debt, this kind of increases the default risk of GO bonds, in particular for state governments, which may have an adverse effect on borrowing costs. And kind of another unique feature of these markets is the fact that sort of the legal priority of pension liabilities and also bonded debt are not really set in stone, kind of unlike a corporate environment where you have kind of defined hierarchies of which debt is senior to which. It's unclear from a legal standpoint, at least that's kind of my understanding, that the seniority of pension liabilities as opposed to bonded debt are not set in stone. So kind of with these thoughts in mind, sort of what I'm trying to tackle in this paper are a few questions. First is kind of just, do underfunded pension liabilities affect state borrowing costs? Certainly, I think anecdotally we think yes, but really a lot of what I'm going to try and do is say, okay, quantitatively, but by how much? And what's really the marginal effect of these underfunded pension liabilities on yields for state governments? And then I want to ask questions such as, how does this compare to the effects for actual bonded debt? So if you looked at, for instance, at like a long-term debt coverage ratio for states, how does this effect on yields compare to that for pension liabilities? And then I want to think a little bit about this fact that there's kind of an unknown or uncertain seniority structure between pension liabilities and bonded debt. And I want to ask, how do markets account for the fact that certain states have varying levels of legal protections for pension liabilities? And how does that interact with underfunded pension liability levels themselves? So you can kind of imagine the thought experiment here is that in states with greater legal protections for pension liabilities, markets see them as more senior, so therefore movements in the funding level for the state are going to have a larger effect on debt spreads. And kind of a couple other political economy questions I tackle kind of in the second part of my paper, which hopefully I'll get to a little bit, is if ultimately what's going to happen in some sort of fiscal crisis or even a default event is some sort of bargaining that goes on between pensioners and debt holders, for instance, like something that happened in Detroit, to states, for instance, with larger union presence, which may be proxies for greater bargaining power for pensioners, are these liabilities seen as more senior in these states and have an adverse effect on borrowing costs? So just a quick preview of my results. Essentially what I find is that a 1 standard deviation increase in the pension underfunding to GDP ratio for a state government leads to about an 18 basis point increase in credit spreads. These economic magnitudes are similar for bonded debt. And I also find that the effect of these pension underfunding ratios are much stronger in states with stronger protections for pension liabilities. And I think this provides some suggestive evidence that states are taking these constitutional protections as material and factoring them in when setting bond yields. I also find some kind of suggestive evidence that indeed pensioner bargaining power does increase bond yields at the state level, again suggesting perhaps that the perceived kind of pecking order of these liabilities in a fiscal crisis may be higher. And kind of really the big takeaway thing here is that the idea of underfunded pension liabilities are not really just a problem for down the road. This isn't a problem that the states are not going to be able to pay them in 10 years. I mean, that might be the first order concern. What I'm trying to highlight is that states are already paying higher borrowing costs as a result of these underfunded pensions. So this, I've kind of mostly gone over this. This is a little bit of summary of what I was talking about. So what I do use in the bulk of my paper to proxy for state government borrowing costs is I'm actually using credit default swap spreads, which are traded on state governments. The reason I do use these for the bulk of my paper is that I guess I kind of see them as a cleaner measure of default risk than state bonds. Unlike state bonds, I don't have to worry about varying optionality of contracts, varying different features. There's just less to control for. So kind of the way, for those that aren't familiar, credit default swap contract is essentially a buyer pays a spread to buy insurance against a default risk of an underlying entity. So if, for instance, the state of Illinois defaulted on their bonds, if you own the CDS contract, you would be made whole on whichever bond you had bought protection against. And these contracts are very standardized, so I don't have to worry about varying contracts of different types of GO bonds, for instance. That being said, I will say I do everything kind of in the paper also with underlying bonds themselves, and all my results are qualitatively similar, so I'm not too concerned about it biasing the results. These are just some summary stats for people who aren't familiar with what these look like. So one of the drawbacks of the CDS are that they're only actually traded on 27 of the 50 states during my time period. Unsurprisingly, you see things like spreads kind of increasing during the financial crisis and coming down. Similar patterns that you would see if I just looked at average statistics for GO bonds. So what am I doing to kind of control for fiscal conditions at a state level and also pension funding? So I've collected a bunch of balance sheet information from comprehensive annual financial reports from state governments. I'll talk a little bit about the kind of specific variables I use. And I use this both to control for other fiscal conditions that aren't at least directly related to pension underfunding, so that I can try and get at the marginal effects of pension funding on bond yields. And I supplement this with sort of the public pension plan data from BC Center for Retirement Research to calculate the actual pension funding ratios for each state in my sample. So it's kind of the main analysis I'm doing here is I'm just kind of running simple regressions of the level of the credit spread for each state and year. On kind of my main variable of interest is this pension funding ratio where I look at the amount of pension assets minus the pension liabilities, and I scale by each state's GDP. I scale each kind of variable by GDP to just kind of standardize across states with different sizes. There's nothing special about GDP. My results are very similar if I use, for instance, something like income at the state level or revenue. And so all in all, I have, by looking at kind of the fiscal data, I have 212 observations from 2005 to 2016. And I'll kind of just, at this point, jump into the results. So kind of what you're looking at here, so the other variables in my main specification that I'm kind of controlling for, I look at the revenue minus expense ratio as a share of GDP, current assets minus current liabilities, and long-term assets minus long-term liabilities, in addition to kind of this bottom line item here in the top half of the panel, which is kind of my main variable of interest, which is the pension asset to pension liability ratio. And kind of what this, if you look particularly at column 4 here, kind of the main finding, this coefficient of the 17.94, what you can think of this as is a state year observation with a 1 standard deviation improved pension funding ratio is going to have an 18-point decrease in their credit spreads. And kind of one concern that you might get from looking at this is that really what this is being driven by is sort of other underlying economic factors that are going on at a state level. So kind of in my next table, what I do is I add 2 additional control variables to account for this. So the one, this econ index, is the Philadelphia Fed's coincidence index, which essentially is an index of economic activity at a state level, and also a housing price index for each state. So again, if you look kind of in column 5 here, I'm now controlling for some additional underlying economic conditions and showing that kind of my main results are unchanged. The coefficient on the pension funding ratio has decreased a little bit to about 16, but still very statistically significant. So kind of again, the takeaway here is that these pension funding ratios are having a large effect on the magnitude of 16, 18 basis points on credit spreads. And it's similar if you look the same coefficient on this long-term asset coverage ratio, the A minus LTL, they're in a similar ballpark, which suggests that markets are kind of accounting for these pension liabilities in a similar magnitude as they would count for any other bonded obligation. So kind of, I just kind of summarize this, my main results again are this fact that pension funding ratios, a 1 standard deviation change in them seems to have about an 18 basis point effect on spreads. I don't have it in the slides here, but in the paper, I also go through kind of for the econ wonks in here, an instrumental variable exercise where I instrument for the pension funding ratio using pension asset returns to kind of try and show that this really is a causal relationship, which I'm sure is not surprising to most people in this room. But it really does seem to be that markets are taking into account these pension funding ratios when setting bond yields. So what's sort of the magnitude of these effects just beyond the basis point? So this is sort of kind of like a back of the envelope calculation here. So for instance, if you took the state of Illinois, if they got up to full pension funding ratio, essentially based on my regression results, what this would result in is about a 60 basis point improvement in spreads. And if you look at Illinois with about $26 billion in outstanding general obligation debt, if they're paying an additional 60 basis points on each dollar of this debt every year, they're paying about $160 million in borrowing costs each year just due to these pension underfunding ratios. Again, kind of one of my main takeaways here being that state governments are already paying for these underfunded liabilities in the form of high borrowing costs. So kind of the second main area I focus on in my paper is looking at differences in constitutional protections for pension liabilities across states. So certain states within their constitutions have either explicit protections for pension liabilities, saying that state governments must pay these out prior to any other obligations. And there's also some weaker contract level protections for pension liabilities. So I'm using kind of definitions by Monell and Quimby here of these constitutional protections. And what I want to look at is now how do pension funding levels, their effect on spreads, change across states based on these legal protections? And essentially, are markets taking them into account? Does it sound like they're material? So what I add now to kind of my main specifications are a couple interaction terms where I'm looking either at this explicit protection dummy variable or just a protected dummy variable interacting with the pension funding level ratio. And I'm showing that there's essentially, if you look, for instance, at column 3, a lot of what's going on, this effect of the underfunding on debt spreads, is being driven particularly by the states in which there's constitutional protections. So essentially, what I'm kind of surmising here is that markets see these protections as material. They see these pension liabilities as more senior in these states. And therefore, the movements in the pension liabilities are crowding out more of the debt in these states and leading to larger movements in spreads. Kind of really quickly, I'll talk a couple other results. So I now look at a couple proxies for union involvement in a state, both union membership and political donations by unions in a state. In columns 2 and 4, you see kind of it's weaker on the statistical significance, but the direction's going the right way. States with higher union presence are seeing higher borrowing costs. I don't really have a great causal story for this, but you could create stories where markets see pension liabilities in the states as more senior because pensioners would have greater bargaining power in a fiscal crisis, and they're factoring that into bond yields today. And kind of my last main result, I also look at whether pension funding at a local level matters for state borrowing costs. So now I'm just looking at the pension funding ratio for the localities within a state. So for instance, if you look at column 3 here, you see a similar magnitude effect for local pension funding on state government borrowing costs. And you could tell stories where if a government, so I also look at whether states are kind of proactive, in the definition of Paul Gao, who's I think presenting in the other room right now, in the paper they had done, and looking at whether this has an effect on the yields themselves. The idea being that perhaps states who are more willing to help out localities in trouble might be dividing more resources to help them with pensions in a crisis, and are therefore seeing higher borrowing costs today because of that expected future cost. So just to kind of wrap up, so kind of my main result here is I find that pension funding has a strong and robust statistical relationship with borrowing costs at the state level. A 1 standard deviation improvement in the pension funding to GDP ratio is associated with an 18 basis point decrease in spreads. And I find some suggestive evidence that markets take legal protections for these liabilities seriously, and that pensions are having a larger effect on spreads in states where they are seen as more senior. And again, kind of my main takeaway is that this isn't just, the pension problem is not just a problem for down the road when we have an inability to pay. This is something that governments are already facing in the form of higher borrowing costs. Thank you.
Okay, my name is Natalie Cohen. I am in charge of municipal research at Wells Fargo Securities, so sell-side research. I'm not a statistician, so some of the numbers, I need to go back to my grad school days myself and say, how does this standard deviation work exactly? And I also want to just say, I think it's terrific to have a paper like this that is showing the consequences today of issues that a lot of governments are kicking down the road to later and kind of shoving under the rug. And I think that, we need to do more of this. So my comments in that context, I have a couple of quibbles that I'd like to take. I did discuss these with the author, and I think that some of them are actually kind of universal sort of misunderstandings or generalizations that we see a fair amount. And I think it's important to take the good statistical work like this and not extend it into some, and I'm going to get into that. I'm going to talk a little bit about the choice of the proxy of the credit default swap, a little bit about the attempt to associate union involvement with higher spreads, and then the term bailout, which Chuck didn't mention here, but was in the paper a fair amount. I find a very loaded term, and I think underneath it there's a lot of discussion about that should be had about states that have oversight over local governments, and also what that actually entails, whether it's, bailout implies I'm going to pay for something that you're not paying for, and I'm going to take it over. And I don't think that's exactly what's happening out there, and it's a bit of a loaded term, I find. And then finally, another area is in terms of actually distinguishing plans in a pension. I see this across the board. I see this in some of the Pew studies. I see this in Bloomberg and in a lot of different well-respected writers that just talk about a state plan as if it's a uniform single plan, whereas underneath it you have the state employees in a plan, you have the local employees, and I think there's a lot of distinction. I'm going to talk about that a little bit. So first, to just dispense with the CDS issue, Chuck mentions that they are liquid. They're not. And if you talk to market, there's really very limited trading that actually takes place. They have a sophisticated modeling system that is actually based on muni bond prices. So the fact that his work is showing that if you did go to the muni bond pricing, you come up with very similar, consistent results, is partly because of that. And so I think we can take that off the table and dispense with that criticism, because he does end up in the same place if you look at muni bonds. And I agree, yes, there's call optionality and all kinds of murky stuff in our muni world, and CDS is a cleaner statistic to work with, but I think it's important not to call them liquid. Because it's not, it's just not. Okay, so, and I was glad actually he concluded, you know, the union and collective bargaining issue. I mean, I would say New York State has the highest union participation of any of the states in the country, and there's a list going down, and Illinois is not among the top new numbers. So I think there's some bias in there to like try to pull that out and say it's because the unions are paying politicians. There are lots of other PACs and entities that are paying politicians to get elected to express and represent their views. And I think I think that he did point out that none of the coefficients were statistically significant there. Back to the New York example, New York's pension systems are generally better funded than many of the other systems. So I think that that's at least one large example. The other thing I think in terms of bond pricing that's important and does come out in the numbers is a number of counterpoints. One I would mention, you know, the state of California, and you had that in your chart of the spreads. California's spread gapped out huge when they had, right after the recession, we had the huge financial markets downturn, and California had a significant deficit. 27 billion is what stays in my mind. California's tax structure is very heavily tied to capital gains tax, and you can map it. I've mapped it in some charts that there's this huge volatility that takes place when the financial markets are up. They've got surpluses. When financial markets are down, they have deficits that come out. Other states, like the state of Illinois and others that have the state income tax tied, that taxes capital gains, also have that kind of volatility. And so that was, I think, a point at which, in fact, the rating agencies, or S&P in particular, had lowered California to an A- at a certain point in time, which was lower than the rating on Puerto Rico. Just pointing that out as a side fact. They got a little beef on that one, but they did, you know, they have readjusted and come back up. And the second factor is the commodity states. We've seen tremendous fluctuation in the oil and gas states in terms of their fiscal condition, their ability to pay into their funds, and their pricing in the markets, and their rating downgrades. So the rating agencies have taken that into account as well. So I'm just throwing in some counterpoints of other factors that affect bond pricing in a pretty significant way. The other thing that was kind of interesting in looking at his time series work, I think there was some noticeable shifting when the GASB rules took hold. And so it might be worth looking at the time series in terms of other external things that might have caused such as transparency and the awareness that pension liabilities are an issue. I think in spite of a lot of proclamations that the rating agencies have always taken pensions into account, there's been significant downgrades, particularly at the state level, for underfunded pensions in the last year and a half to 2 years. So that also has an impact on pricing. Okay. The issue of bailout, just to talk about that, again, like I said, that's a loaded term. If you look at, people hold up North Carolina as an example. North Carolina and New Jersey, after the Great Depression, implemented oversight of their local governments. And what's involved in that is a pre-default or pre-stress look. And having traveled in and out of North Carolina a fair amount and talked to local government, they would consistently say to me, we could never do that. The North Carolina Government Commission would never let us do that. They accept it, they live with it, they don't see it as a compromise of their local power. That probably took place in the late 30s, early 40s, where they fought that battle. But they consistently have higher ratings and I would argue lower cost of borrowing. 2 more minutes? Okay, I'm almost there. And so to the point about separating out the plans, I think if you look at, in Illinois, the IMRF, which is the Illinois Municipal Retirement Fund, it's better funded. Why? The governments were made to put their money in. In North Carolina, they will evaluate a local government's budget, and if you don't have the money in your budget, as you should, over time, then your budget's not going to get accepted. New Jersey local government has looked at it the same way, where you have to have your budget put together with the proper pay-ins in place. So the local government plan in New Jersey is also better funded than the state level plan. The IMRF is better funded. I think that cuts across as well to some entities in Connecticut and also in Pennsylvania, where there's been oversight, I wouldn't say bailout. So I think it's important to tease some of those factors out in doing this. And also the other important factor is the difference between the agency and the cost share plans. That is something that gets slushed over a fair amount. There have been papers written about the cost share plan. To my mind, if you just take a step back and say, why would we want a state legislature deciding how much money should get paid into a plan versus a series of actuaries and a series of rigorous studies about the assumptions? But the cost share plans do tend to have more poorly funded pension plans, and those are for school districts, universities, teachers, and so on, to a large extent. So that would be the difference between CalPERS and CalSTRS in California, and so I wanted to make that point. So ultimately, and we did talk about this over the phone, the issue is really, paying in. You got to, if you're forced to pay in, and you pay in and have consistently and regularly over time, yes, you'll be subject to market fluctuation and you'll have losses depending on your investment strategy, but not paying in is a critical component of some of the problems that we have today. And that's been true for Chicago, for Illinois, Kentucky, Connecticut, even Ben Watkins in well-managed Florida yesterday mentioned a pension holiday that they had to put in effect because of their budget issues. So, okay, I got the time thing here. Oh, we're sitting up here, okay.
Do you want to be in the middle, or do you?
I can sit at the end. I'll sit at the end. And I guess you turn this. All right, so we're going to open it for questions, but I just want to start with a couple observations. One thing I would say is throughout this conference, it seems like the rating agencies keep getting beaten up. For full disclosure, I've worked for Fitch Ratings for 15 years, but I would say similar to GASB putting the liability on the balance sheet. I think the rating agencies have really done a good job of making the pension liability more transparent and measuring it as debt and stress testing it with different discount rates. And I think that has been embraced by the market in terms of how they value, and of course the rating is one thing, but just how they value debt and what sort of interest rate people pay. Similar to Natalie's question about oversight and bailouts, and you had mentioned that when it's more likely that there would be a bailout, that would lead to higher borrowing costs for the state government, because people would perceive that they're going to have to put resources in. And I would just echo what Natalie said, and it's in most places where they have fiscal emergency laws, those are usually precede any sort of risk that a pension payment won't be made. And, there's some as strong as North Carolina where your budget doesn't get approved, and then there are states like Michigan that really step in to try to reorganize your finances so that you can meet these obligations. So those were just two observations I had on the paper.
Oh, the one with the mouth and the words or something coming out. Okay, sorry. And I think also the other point, and this is true for Michigan and Detroit, you have a state legislature in there that has to actually approve any kind of a, quote, bailout. If you followed the sequence of the grand bargain that took place with Detroit, the legislature was not, they weren't on board very easily, and there was certainly a lot of heavy discussion from the upstate or outside the Detroit area folks. That's certainly true in Illinois. The Chicagoland, Cook County areas wouldn't necessarily vote for an easy bailout, and then at the end of the day, they did go along with the plan, but they present valued the dollar amount so that it was smaller. So it minimized the impact on the state. So I just wanted to mention you do have sort of some friction with legislative approvals on any kind of a bailout.
And you do have to have an art collection to take that.
Well, they were, had an asset.
Any points or?
No, I will just say, I appreciate the comment. I think kind of my language in the paper so I didn't get into this as much in the presentation, but I do have a section where I look at kind of pension funding at the local level and see what effect that might be having on state borrowing costs. And as you mentioned, I look kind of at this very proactive that Gao et al. Had used. And I think you're right. It's not about bailouts, and I shouldn't really talk about it that way. To me, it's just some sort of proxy for markets perceiving kind of greater involvement at a state level, which could perceivably take resources. That being said, my results on that kind of front are kind of weak to begin with, so it's probably not there at all, or if anything, very small. So,
great. Good questions. Questions from the audience.
Hey, Louise Shanner. So I had a question about holding constant economic conditions, which I think in general makes sense, but you might think, the pension holiday example kind of brought it to mind, which is sometimes it makes sense from an economic perspective to not make a pension contribution, right? It might, you might actually have a better recovery from a recession if you don't cut back on state and local spending so much. So you're kind of taking that out. So it could be that the net effect of not making a pension contribution is actually positive for your borrowing. It lowers your borrowing costs, but you're holding constant the outcome of that. So I don't know if you had thought about that at all.
No, I think that's an interesting point. I think after having conversations about this, one thing I do kind of want to look at more seriously is about what's actually going into the pension funding and looking that separate than just kind of the funding level itself. It's important. Markets presumably see something very different between two equally underfunded pensions, but one that's on the right path towards paying them off and one that isn't. And I think your point is probably correct. So kind of my results looking, for instance, at constitutional protections for states, and the idea that a lot of this effect of the underfunding is kind of concentrated in states where there are greater legal protections for pensions means there is sort of some dynamic going on here. It's not just about the pension level, it's about also how senior they're seeming, or presumably like whether they're on the right path, paying them kind of as they should be. So,
Question here.
Can I follow up on that, Carol O'Claricon? I was curious as to how statistically you deal with a situation like Illinois, which didn't have a budget for 2 years. I mean, the interaction of all of these factors, I mean, if you added up all the negatives, right, for Illinois, it's more than just pensions. And so I'm curious as to whether you have statistically a way to deal with that, or you just ignore it.
So I guess the short answer is what I showed today is I do kind of ignore it. It is at face value. I'm showing you what I'm kind of controlling for. I do kind of in the paper go through a slightly more rigorous kind of statistical exercise where I look at an instrumental variable exercise where I essentially proxy for pension funding level by your return on your pension assets. The idea being there that just the return you get on your assets in a given year is kind of random. It's not necessarily correlated with other things you're doing at a state level. And that tries to tease out sort of a more causal relationship between just the pension funding level itself and the debt yields. But I think your point is taken that there is a lot certainly that's going on at a specific state level. For instance, somewhere like Illinois with not passing budgets that I'm not explicitly capturing.
Yeah, and as an economist, I'm going to sort of press it further because I've always been very conscious as to the crude variables we end up having to use in these kind of econometrics and how unsatisfactory they are. And I was looking at your union one thinking, oh, well, anybody looking at Detroit would say highly unionized and whatever, but if you really look at the data, Michigan is now a right-to-work state, and it kind of depends on what point in time, right, when you're actually doing it and when it might have affected any of your other variables. So it's so murky to try to get these kind of real-world realities into statistics. So I think the broad brush of what you did is a really good thing to do. And then you just start getting into the details. It gets more and more spongy.
And it is important to walk away from some of the details and actually be able to put a paper together without, 1,000 bullet holes in it. But I wanted to just mention, back to Louise's point about decision-making and the cost of borrowing for a state. It may be the right decision at that point in time for the economy to say, we're going to take a pension holiday. I don't think the markets, because you're going to be doing that in a bad time, in a tough economic time. And so I don't think the markets would necessarily say, oh, this is the right decision. They're going to come back around and start putting the money back in, and we'll give them credit for that in the bond pricing. So
You don't have to realize that's what's going on. It could be that the forecasts improve, and they say, oh, well, economic conditions aren't as bad, so I give credit for that. Right? So the market doesn't have to understand the causality for it to still be a factor, right? Which is if actually not firing your teachers improves your economic outlook, then and it's because you didn't make the pension contribution that you didn't have to fire your teachers, then it may well be that you get a better recovery, and so that you can price both. But in the causality, you kind of want to take them both into account.
Right behind you.
Laurel Pressing from Urbana, Illinois. Illinois has a 3% increase every year for pensions, people who are receiving pensions, and I just wonder, is that done in other states?
The compounding of the,
you're talking about
benefit.
cost of living adjustment?
Yeah.
COLAs?
Yeah, it's compounded.
It's a flat 3%, and when it was instituted, it wasn't very big, but it's just this giant thing that's eating up the state.
There are a lot of different varieties and flavors of various annual adjustments, and some are ad hoc and some are baked into the numbers. So, they originated in a very high inflationary time period, and we've obviously not had that for quite a long time. So it's excessively above what the true cost of living adjustment is. But there is a range of legal decisions that have been made. Courts have heard arguments pro pro and con on the cost of living. Colorado, I'm thinking of Minnesota and so on. So yeah, it's out there. It's definitely out there.
I think this young lady behind.
Hi, this is Laura from the Center for Retirement Research. I just want to talk about the COLA really quickly. So the 3% you're referring to is supposed to be a cost of living adjustment. Obviously, it's not tracking with inflation, but I'd also like to add in Illinois, for new hires right now, it's a simple COLA. It's not compounding. So it's actually a lot less generous than you might think at first glance. That's a trend that we've been noticing. The COLA has seemed to be one of the easiest benefits to cut, especially for current employees. It's the first thing on the chopping block. And also in Illinois, the workers are not in Social Security. So the pension is their only DB retirement income that they have.
I think get over on this side here. Yeah.
Thanks. I'm Bill Glaskell from Volcker Alliance. Just a couple of questions and comments. I don't know if it's proper to say that an X increase in pension funding or an X decrease in pension funding results in an increase in borrowing costs or credit costs for the government, because there's the stock of debt and then there's new debt. So if you take a lot of Illinois' debt is already on the books. If the spreads widen, the ones who are going to that affects the investors. That doesn't affect Illinois. So you have to really roll over the entire stock of debt to get the numbers you're working at. It's a common thing. To say when I was at Bloomberg, we would throw that into stories, but it's not correct. So it's a slow. Your point is right. It's a slow process. Eventually, Illinois will end up paying that as all the debt rolls over, if it can. So that's something to consider. The other thing to consider is the structure of debt. Chicago has one of the worst pension underfunding problems anywhere on earth. They just did a general obligation bond that was well received. It punched above its weight in terms of spreads because it was structured to be bankruptcy remote or bankruptcy unlikely. And of course, you have the New York City. You have sales tax bonds, personal income tax bonds. The extreme was the Puerto Rican COFINAs, and that turned out so well. But when they were issued, they were AAA. Puerto Rico was not a AAA credit. So you got to look. I think. If you go back at this, you should look at the structure of the state debt and not just use CDS spreads or Bloomberg or Bloomberg indicative spreads. But you need to look at like a clean GO spread.
So if I could just two things. One, you're completely right about the first point. I have that slide, sort of the magnitude of the effects, where I do that calculation. That's not even in the paper. It's something because I should have said something immediately that's exactly right. That's if they rolled everything over. On the second point, I just lost my train of thought. I'm sorry. What was the? Oh, the structure. Sure. So part of the reason originally I did use CDS was to kind of avoid some of these issues that I didn't have to worry about the structure. And when I do it with GO bonds in the paper, I try at least to make some effort using a lot of what I can get out of margin anyway to control for a lot of the structural features of the debt, in addition to kind of the other characteristics that I have here.
Great. All right, we're gonna move on to our next presenters. We're out of time, but certainly feel free to ask questions.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.